Welcome back to the deep dive. Today we're stripping the paint off a business that at first glance looks like the definition of watching paint dry. And I mean that as a total compliment.
Oh, absolutely. I mean, boring is usually where the alpha is. If a sector is exciting, it's probably already crowded. But if it's boring, it's probably quietly profitable.
Exactly. And we are looking at a classic pick and shovel play today. But the gold rush here isn't AI data centers or lithium or anything like that.
Right.
It is the absolute chaotic $4 trillion mess that is the United States healthcare system.
Yeah.
And the company is Sagility India Limited.
A healthcare system that honestly seems designed to generate paperwork first and health outcomes second.
Yeah, it really does.
Yeah.
And Sagility is effectively the plumbing for all of that.
They are.
They're a pure-play business process management company, a BPM, that basically handles the massive administrative backend for U.S. insurers and providers.
Which means they're the ones making sure the claims actually get paid, the members get enrolled, and the hospitals don't go bankrupt waiting for checks to clear.
Right. And on the surface, it looks like a standard labor arbitrage play.
Yeah.
But when you dig into the unit economics, which you have done for us today, it's actually a technology-enabled efficiency play.
It really is. And the numbers for FY25 and the start of FY26 are, well, they're forcing fundamentals investors to pay very close attention.
So let's hit those numbers right off the top, because for anyone listening who looks at fundamentals, this is the hook.
Yeah.
We're looking at a revenue run rate that is aggressively accelerating.
Yeah.
So FY25 revenue hit 5,570 crore rupees, but Q3 of FY26 just posted nearly 36% year-over-year growth.
And that acceleration is key to the whole thesis. Usually in these BPM models, you see steady linear growth, right?
Oh.
Like in the low teens.
Right.
But 36%. That implies we're actively taking share or the market velocity is fundamentally changing.
And they're doing all of this with EBITDA margins sitting comfortably at 26%.
Which is really the standout metric here. I mean, if you look at the comps, the generic IT services companies, the Wipros or InfoCCs of the world, you're usually modeling maybe 18 to 22% margins.
So hitting 26% suggests they have real structural pricing power.
Or a cost base that is significantly leaner than their peers. Or both.
But here's the paradox we really need to resolve in this deep dive. Despite those massive margins and despite that growth, they have a market share of exactly 1.23%.
Yeah, just over 1%. It's tiny.
So the mission for us today is to figure out what that means. Is this a David versus Goliath scenario where their runway is effectively infinite, or are they just a commodity player in a super fragmented room who happen to string together a few good quarters?
That is the ultimate thesis question. We have to determine if that 1.23% is a foothold for a durable compounder or if they're capped.
Right.
And to do that, we really have to strip away the AI buzzwords that management puts in the investor decks and look at the actual raw unit economics. We have to look at the workflow and the stickiness of the revenue.
And the regulatory risks, which could theoretically wipe out parts of their business model overnight.
Exactly.
So let's get into section 1 right away. The business model. One of our sources calls this profiting from complexity.
It's a very apt title because Sagility sits right at the intersection of the two warring factions of U.S. healthcare, the payers and the providers.
The payers being the massive insurance giants like UnitedHealth, Cigna, Aetna, and the providers being the hospitals, the diagnostic centers, the physician groups.
Correct. And you have to remember the relationship between these two sides is adversarial by design.
Inherently adversarial.
The provider wants to bill as much as possible for a service. The payer wants to pay as little as legally possible. And Sagility sits right in that messy middle, managing the data flow for both sides.
So let's break down that revenue mix.
Yeah.
Because the payer side is the dominant chunk of their book, right? Roughly 50 to 60%.
That's that.
But what is the actual work being done? Because when you read claims adjudication on a balance sheet, it sounds incredibly abstract.
It sounds abstract until you realize the sheer chaotic volume of data involved. Think about the life cycle of a single medical claim. You go to the doctor records a diagnosis.
Right.
That diagnosis then has to be translated into an ICD-10 code. Then the actual procedure they performed has to be translated into a CPT code.
And there are literally tens of thousands of these codes.
Thousands of them, and they update them every single year. So if a doctor's office uses a code from 2023 on a procedure done in 2025, the claim just bounces.
It gets denied.
Exactly. Or if they code a level 4 office visit, but the clinical notes only support a level 3 visit that is potential fraud. or at the very least an overpayment.
So on the payer side, Sagility is essentially acting as the auditor.
They are the gatekeeper. They run all these claims through their software engines and their manual review teams to make a simple decision. Pay, deny, or pen for more information.
And that is mission critical for the insurance company.
It is everything, because every single dollar they don't pay out in error is a dollar that drops straight to their underwriting profit.
Which means Sagility's performance is directly correlated to the insurer's medical loss ratio, their MLR.
Exactly. If Sagility does a sloppy job, the insurer's MLR blows up and their stock tanks on Wall Street. That is why the customer stickiness here is so incredibly high.
You don't fire the guy guarding the vault just to save a nickel on administrative fees.
You really don't. It's too risky.
So that's the payer side.
Yeah.
Then you have the provider side, which is called revenue cycle management, or RCM. And that makes up the other 40 to 50% of their TAM.
And this is the exact mirror image of what we just talked about. This is Sagility helping the hospitals fight back against the insurers.
Which is kind of funny when you think about it.
It is. The hospital says, we did this surgery, pay us. The insurer says, wait, you didn't get prior authorization, or you coded it wrong. Sagility helps the hospital navigate all that bureaucracy to make sure their day sales outstanding doesn't just balloon out of control.
It's fascinating that they play both sides of the board. Doesn't that create a conflict of interest?
In a strict legal sense, usually no, because they are servicing different specific clients on different specific transactions.
They have firewalls in place.
Right. But strategically, it actually gives them a massive data advantage. They know exactly why claims are being denied by the big payers because they process those denials.
Oh, wow. So they can use that intel.
Exactly. Which makes them significantly better at helping their provider clients submit clean claims in the first place. It's a closed feedback loop.
That makes a lot of sense. Now let's look at the operational scale of this. We were talking about roughly 40,000 employees.
It's a massive physical footprint.
30-plus delivery centers spread across 5 countries: India, the Philippines, Jamaica, Colombia, and the U.S.
And that geographic mix is actually really important for their nearshore capabilities, because some U.S. clients' strict regulations require onshore or nearshore handling for highly sensitive patient data.
Or complex voice interactions where an American accent is preferred.
Right. But obviously the core margin engine driving the profits is India.
Now, one distinction the analysts make in our sources is that Sagility is a pure play.
Yes.
Unlike a Genpact or an Accenture that does everything from retail banking to supply chain, Sagility only does U.S. healthcare. Does that distinction actually matter for an investor looking at their multiple?
I think it matters tremendously for their win rate on new contracts. Think about it from the client's perspective. If I'm the CTO of a regional Blue Cross plan and I have to choose a vendor,
Right.
Do I want a generalist BPO who is going to throw generic bodies at my problem? Or do I want Sagility who brings a team that is already certified in IPA and understands the latest CMS guidelines?
I'm taking the specialist every time. It just reduces the ramp-up time so much.
It reduces the time, but more importantly, it reduces the regulatory risk. Healthcare is the single most regulated industry in America.
One data breach and you're done.
One breach, one violation of the No Surprises Act, and the federal fines are astronomical. So domain expertise acts as a literal hedge against liability.
That's a great point. Let's pivot to the tech-enabled aspect of their model versus the old-school body shop model. Because we see this evolution in almost every IT services deep dive we do.
The shift away from selling hours.
Exactly. Moving from time and material contracts to outcome-based pricing.
And this is critical for understanding that 26% margin profile we talked about. In the old world, you billed a client for 100 hours of work. If you invested in better software and suddenly did that same work in 50 hours, you actually lost revenue.
Right. It was a totally perverse incentive. Efficiency was the enemy of your top line.
Sagility is aggressively pushing what they call BPS, business process, as a service. So they go to the client and say, don't pay us an hourly wage, pay us a flat fee per accurate claim, or even better, pay us a percentage of the fraud we catch.
Oh, that's the payment integrity piece from the outline.
Exactly. If Sagility's algorithms flag $1 million in duplicate billing that the insurer was about to mistakenly pay, Sagility might take a 10 or 20% cut of that exact savings.
And that is pure margin.
High-octane, pure margin. And it completely aligns their incentives with the client. Now, Sagility genuinely wants to use AI. They want to automate as much as possible.
Because if they can find that fraud with an AI bot instead of a human reviewer in Bangalore, their cost basis drops to basically zero. but their revenue share stays exactly the same.
Correct. It shifts them from pure labor arbitrage to value-based pricing. It separates them from the commodity call centers.
So when we see that EBITDA margin sitting at 26%, that's really the outcome premium showing up in the P&L.
Yeah, that's exactly what it is.
Okay, let's move to section 2.
Yeah.
The market and the moat. Because we need to talk about this 1.23% opportunity.
It is a deceptively small number, isn't
Very
it?
deceptive. The total addressable market, the TAM, for this specific slice of healthcare BPM is estimated at $15 to $20 billion. And Sagility has roughly 1.23% of that.
Right.
So the bull case is obviously look at this massive runway, but the bear case has to be, well, why haven't they scaled more? What's stopping them?
The nuance here is how you define the market. Because Sagility's biggest competitor isn't Accenture or Cognizant.
Oh, where is it?
It's the clients themselves. It's the in-house departments. Roughly 85 to 95% of this administrative work is still done internally by the insurers and the hospitals.
Wow. Still that high?
Yes, they have these massive back offices in places like Des Moines or Tampa, just filled with thousands of people manually typing this stuff out.
So the real thesis isn't just steal market share from Cognizant. It's convince the entire U.S. healthcare industry to capitulate and outsource their back office.
Exactly, and that capitulation is happening right now because of massive structural tailwinds. If you look at the macro demographics, the U.S. population is aging rapidly.
Right, something like 10,000 people turn 65 every single day.
Which means they age into Medicare, which means healthcare utilization skyrockets. Older people go to the doctor more often.
So claim volume just naturally goes up across the board.
Volume goes way up, but at the exact same time, the U.S. workforce is shrinking, and wage inflation is incredibly sticky. So if you are a hospital CEO facing a margin crunch, you literally cannot afford to hire 500 more billing clerks in Nebraska at $25 an hour.
You have to outsource just to survive.
Inflation is the ultimate catalyst for outsourcing, and it's inflation combined with regulation. You mentioned the No Surprises Act earlier.
Yeah, how does that impact this?
That legislation fundamentally changed how billing works for out-of-network care. It requires a level of real-time data synchronization between the payer and the provider that legacy software systems just cannot handle.
It creates a massive complexity spike for everyone.
And as we said, complexity is Sagility's best friend. If billing were simple, you'd just automate it with a basic Python script. But because it's highly regulated complex and requires human judgment, you need a managed service provider.
But let me play devil's advocate here on the competitive landscape.
Yeah.
How do they actually win against the whales in the space?
What do you mean?
Well, UnitedHealth owns Optum. Optum is an absolute monster in healthcare services. Why doesn't Optum just crush a company like Sagility?
It's a great question. First, Optum is a fierce competitor, but they are also a subsidiary of UnitedHealth. So put yourself in the shoes of Cigna or Humana.
Oh, I see.
Do you really want to hand your entire back office operation and all your proprietary claims data over to the subsidiary of your biggest rival?
No, absolutely not. That's a massive strategic conflict of interest.
Exactly. So there's a real premium on being a neutral third party. Sagility is Switzerland. They are completely agnostic, and that helps them win deals against the payer-owned BPMs.
That makes total sense. Now, what about their acquisition strategy? They recently bought a company called BroadPath. How does that fit into their right to win?
BroadPath was a very specific tactical move by management. The big integrators, the Accentures, and the Optums, they focus on hunting the whales. They want the top 5 national insurers. They want the billion-dollar mega deals.
Right.
Sagility is using the BroadPath acquisition to attack the mid-market.
The Tier 2 and Tier 3 payers.
Exactly. The regional health plans, the specialized Medicare Advantage plans. These organizations are too small to get the A-team from a giant like Accenture, but they are way too big to handle the regulatory complexity on their own.
So Sagility comes in and offers them that white glove specialized service.
And the pricing dynamics in the mid-market are often substantially better. UnitedHealth will grind your margins to dust because they have ultimate purchasing power.
But a regional Blue Cross plan has a lot less leverage. So Sagility can preserve that 26% EBITDA margin.
Precisely. It's a very smart sandbox to play in.
All right, let's move to Section 3. Financial forensics. We have touched on margins, but I want to look closely at the balance sheet and the capital allocation because this is where the story gets really interesting for the equity holder.
It really does.
We covered the accelerating revenue growth, but looking at the net profit, the PAT for FY25 grew by a staggering 137%.
Yeah.
That is a massive jump that is totally disproportionate to their top-line revenue growth. What's driving that?
That is the deleveraging kicker.
Walk us through how that works.
So Sagility entered FY25 with a pretty significant debt load, likely left over from their original buyout structure or previous acquisitions. Over the last year, they aggressively paid that down. Debt was reduced by roughly 66%.
Wow, so the interest expense line item on their P&L essentially collapsed.
It vanished. This is financial engineering 101, but in the best possible way. As they pay down that principal, the interest cost drops, and all that freed up cash flow drops straight to the bottom line.
Which creates this optical explosion in earnings per share.
Exactly. And if you look at their ratios now, it's incredibly healthy. Their debt to equity ratio is down to 13.85%.
And their interest coverage ratio is sitting at 14.5x.
Which is fortress-level balance sheet territory. A 14x interest coverage ratio means they can service their remaining debt 14 times over just with their operating earnings.
The financial risk of bankruptcy is effectively zero at this point.
Very close to zero, yes.
So let's talk about operating leverage. We're not going to define the concept for our listeners, but we need to see if it's actually showing up in Sagility's numbers.
Oh, it's absolutely showing up. Just look at the delta between their revenue growth and their EBITDA growth.
Right. Revenue grew 17% in FY25.
But EBITDA grew 28%.
That is a beautiful widening spread.
It's the magic of amortizing a fixed cost base. They have already paid for the real estate for those 30 delivery centers. They've already built the core tech platforms.
So now every additional $1 million of revenue they bring in comes with very little incremental cost.
It's the classic fill the hotel model. Once the hotel is built and staffed, the profit margin on the very last room you book is close to 100%.
And in the BPM world, once your bench of employees is fully utilized, the drop through to the bottom line is incredibly powerful.
Which is why we're seeing these margins sustain at high levels even while they are actively investing in growth.
Let's talk about capital allocation signals.
Yeah.
Because their operating cash flow is robust, over 1,200 crore in FY25.
Very strong cash conversion.
And their capex is light because, as you said, they don't need to build massive factories, mostly just computers and software licenses.
Right.
But their dividend payout ratio is currently 0%. They pay nothing out to shareholders.
And as a fundamentals investor, I actually love that.
Really? You prefer the reinvestment at this stage?
For a company with this specific profile, absolutely. Think about it. If they started paying a hefty dividend right now, it would essentially be management admitting that they've run out of high-return growth ideas.
That makes sense.
With only 1.23% market share, they should be aggressively reinvesting every single rupee they generate into sales marketing and targeted M&A.
They're funding a land grab.
Exactly.
Yeah.
The return on invested capital of acquiring a bolt-on like BroadPath or building a new proprietary AI tool is likely 20 to 25%.
Whereas a dividend just gives you a taxable event in cash that you then have to figure out how to redeploy yourself.
Right. I'd much rather have management compound that capital internally at 20%. For a growth investor, zero dividend is a positive signal. For an in-grid investor, obviously, it's a pass.
Okay, let's look at exactly how they plan to deploy that capital to grow. Section 4, the growth vectors. How does a company like this double in size?
Vector 1 is the classic land and expand strategy. It's essentially the sauce metric of net dollar retention, but applied to a services business.
So once they get their foot in the door processing claims for a client, what is the natural upsell?
It usually moves toward clinical or member-facing services. So they'll go to the client and say, hey, we already handle all your claims adjudication. You trust us. Now let us handle your member engagement programs. Or let us take over your grievances and appeals department.
Grievances and appeals. That sounds like absolutely miserable work.
It is deeply miserable, complex work, which is exactly why clients are thrilled to outsource it. But from Sagility's perspective, the customer acquisition cost for that second service is basically zero.
Because you already have the master services agreement signed.
Exactly. You don't have to go through a 9-month procurement cycle again. You just draft a new statement of work and turn it on.
Vector 2 is the AI shift. Now, we touch on this as a margin driver, but let's look at it specifically as a growth vector. How does AI help them win new business?
The growth comes from being able to bid on contracts they literally couldn't touch before. Let's say a major insurer puts out an RFP to process 1 million claims a month, but they cap the price at $2 per claim.
Yeah.
A legacy manual body shop can't bid on that. Their labor costs are too high. They would lose money on every transaction.
But if Sagility has that AI layer we talked about,
they can bid $1.90, win the business outright, and still make a 30% gross margin because their bot is doing 60% of the heavy lifting.
So AI acts as a deflationary force that allows them to capture massive volume.
Correct. It expands their total addressable market by allowing them to compete aggressively on price without sacrificing their unit profitability.
That's a huge competitive advantage. Vector 3 is adjacent services, specifically moving up the value chain into something called utilization management.
And this is the holy grail for a healthcare BPM. Utilization management or prior authorization is not administrative data entry. It is clinical work.
It requires actual registered nurses and doctors reviewing files.
Yes, which means the billing rate per hour is significantly higher. But more importantly, it is incredibly strategic.
How so?
If you are handling prior authorization for an insurer, you are literally deciding what medical care the patient is allowed to receive. You are acting as the clinical brain of the insurance company.
That is a massive responsibility.
It is, and it creates an incredibly sticky relationship. You don't swap out your clinical decision engine overnight just to save a few pennies. The switching costs are enormous.
Okay, so we have built a very compelling bull case here. It's a compounding machine. It's got massive demographic tailwinds. It's deleveraging.
It looks great on paper.
But we are fundamentals investors, and we get paid to find the cracks in the foundation. So let's move to section 5, the bear case. What could actually derail this?
There are several significant risks here, and a couple of them are, frankly, existential.
Let's start with risk 1, the regulatory stroke of the pen. You mentioned utilization management just now. But the government has been looking very closely at prior authorization, haven't they?
Very closely. Both the Biden administration and Congress have been incredibly vocal about streamlining or, frankly, gutting the prior authorization process.
Because the news stories of patients dying or deteriorating while waiting for an insurer to approve a basic treatment look terrible for everyone.
Exactly. And again, we aren't taking a political side here, just reporting on the regulatory landscape from the sources. There is intense bipartisan pressure to force insurers to either automate approvals entirely or remove them for standard procedures.
So if the government steps in and mandates that, say, 90% of routine prior authorizations must be instantly approved without human review,
then Sagility's entire utilization management service line, the one that relies on thousands of nurses and offshore centers reviewing charts, becomes completely obsolete, or at best heavily commoditized.
because if the law says auto-approve, you just don't need a nurse in Bangalore reading the PDF.
Exactly. Any simplification of the U.S. healthcare code is a direct hit to Sagility's revenue stream. Their entire business model relies on the system remaining broken, complex, and heavily bureaucratic.
So if the U.S. ever somehow miraculously moved to a single-payer system or a drastically simplified standardized model, Sagility's value proposition basically evaporates.
It collapses overnight. Now, is that likely in the near term? Probably not, but it is a tail risk you have to underwrite.
Risk 2 is the AI disruption. We keep calling this the Kodak risk.
Right, because we pitched AI earlier as a margin driver for Sagility, but the flip side of that coin is vendor risk.
Explain how that plays out.
Right now, Sagility uses AI tools to serve their clients more efficiently. But what happens if UnitedHealth or Cigna decides to just buy the AI software directly from Microsoft or Google?
They just cut out the middleman entirely.
Exactly. If the AI models get good enough to handle the messy middle, the handwritten doctor notes the blurry faxes, the weird coding errors, without any human intervention at all.
Then the service part of software and service goes to zero.
Yes. Sagility is essentially making a bet that healthcare data is far too messy and unstructured for pure software to handle alone.
They're betting that the human in the loop is going to be necessary for a very long time.
And given that U.S. healthcare literally still runs on physical fax machines in a lot of places, that is probably a very safe bet for the next decade.
But on a 20-year horizon,
On a 20-year horizon, it is a massive question mark. You have to monitor the pace of AI auto adjudication.
risk 3 is client concentration and the broader M&A environment.
We don't have the exact breakdown of their top 5 client concentration in the provided notes, but in this specific industry, it is very typical for the top 5 clients to represent 40 to 50% of total revenue.
So losing even one major payer contract creates a massive hole in the P&L that is very hard to fill quickly.
And you have to remember the competitor dynamic we discussed. If one of Sagility's big mid-market clients suddenly gets acquired by UnitedHealth,
Oh man, then the back office business almost certainly gets migrated over to Optum.
it happens all the time in healthcare. Consolidation among the payers is a major headwind for independent vendors like Sagility.
That brings us to risk 4, the governance signal. specifically looking at the promoter holding.
This is the one that really makes me squint at the screen when I look at the financials. The promoter holding decreased by 16.4% recently.
That is not a small trim for liquidity. That is a significant divestment.
Now, look, promoters sell stock for all kinds of reasons, right? They need personal liquidity. They want to diversify their family office assets, whatever.
Sure.
But we are sitting here talking about this incredible compounding machine with massive growth runways, margin expansion, and an AI revolution tailwind.
Right. If the story is truly that good, why are you leaving the party early?
Exactly. It creates a real alignment gap for minority shareholders. If management truly believed the intrinsic value of the stock was going to double in the next 3 years, they wouldn't be dumping 16% of their stake on the open market today.
It suggests that maybe they think the current valuation is full, or perhaps they see some regulatory headwinds on the horizon that aren't in the public discourse yet.
It's a yellow flag. I wouldn't call it a thesis-breaking red flag, but it is a bright yellow one. You have to weigh that insider action heavily.
All right, let's wrap this up with Section 6, valuation and management quality.
Let's talk valuation first. The
Okay.
current PE ratio is hovering right around 23x.
For a business generating 26% margins and growing the top line at 30% recently.
On a PEG ratio basis, price to earnings growth, it's actually incredibly attractive. If you fundamentally believe that 30% growth rate can persist for even the next 2 to 3 years, a 23x multiple is a bargain. You're paying less than 1 times PEG.
But if that growth suddenly reverts to the industry mean of, say, 10%,
Then 23x is suddenly very expensive for a BPO. It all hangs entirely on the durability of that growth rate.
what about the return on equity?
The current ROE is sitting around 7.4%.
Which honestly seems pretty unimpressive for a compounding story.
It is visually unimpressive, but it is heavily suppressed. It's suppressed by the historical debt load we talked about and some heavy asset-based adjustments. But if you remember that net profit is currently growing at 137% year over year, the forward ROE is going to re-rate significantly higher. You really have to look at the trajectory here, not just the trailing snapshot.
So you're buying the slope of the line, not the intercept.
Exactly. You are buying the deleveraging story playing out in real time.
And what's your take on management quality?
Sagility as a standalone entity is relatively young, formed around 2020 or 2021 through some complex carve-outs, so they have a limited track record of navigating a major industry downturn.
That is true.
However, their execution on the BroadPath integration is a very strong positive signal. They didn't just buy empty revenue, they fully integrated it and actually accelerated the growth of that asset.
And frankly, they're disciplined to aggressively pay down debt instead of doing flashy share buybacks or paying a vanity dividend, shows they are heavily focused on long-term balance sheet health.
They are definitely playing the long game here.
So let's synthesize all of this for the listener.
I would categorize Sagility as a defensive growth play.
Defensive because U.S. healthcare volumes are inherently non-cyclical. People, unfortunately, still get sick and need surgeries during a massive recession.
And it's a growth play because of the accelerating outsourcing penetration and their tech-enabled margin expansion.
It's actually a fascinating way to play the AI theme without having to buy a semiconductor stock trading at 100 times earnings.
Exactly. You aren't buying the AI infrastructure. You're buying the practical application of AI to a boring, incredibly profitable industry. It's applied AI wrapped in a massive regulatory moat.
I love that framing. But I want to leave you, the listener, with one final provocative thought to mull over. We talked heavily about the AI paradox today.
The bridge to obsolescence.
Right. Think about this. Sagility is currently using their own proprietary AI to make their human employees wildly more efficient, which drives their margin expansion today.
But every single claim they process makes those machine learning models a little bit smarter.
So at what point does the model become so smart, so perfectly accurate at navigating the messy middle, that Sagility's massive workforce is no longer needed at all?
Are they the architects of the future of healthcare administration, or are they essentially the construction workers building the exact robot that will eventually replace them?
It is the ultimate existential question for literally any service business operating in the age of large language models. If Sagility can retain ownership of that IP, they win massive. But if they're just renting the IP from big tech, they're incredibly vulnerable long term.
That's why you have to closely watch their outcome-based revenue mix. If that percentage keeps climbing quarter over quarter, it means they are successfully capturing the value of the tech.
But if it stalls out, it means the clients have figured out how to capture it for themselves. That is the key metric to watch moving forward, along with those Promoter sales, of course.
Always follow the money.
Always.
That is going to do it for this deep dive into the surprisingly profitable plumbing of U.S. healthcare. Keep an eye on those insider holdings, and we will see you next time.